Hi, and welcome to step one of completing a Form 1120, which is a C Corporation tax return. So this part is going to ask you to open up the starting template, which will give you the information that you see on the screen. And then you can also see that there's more information in the tabs. So in our Excel workbook, we can click on the various tabs and see the rest of the information. I've made this print ready, but just as a reminder, if you wanted it print ready, one of the easiest ways to do that is to highlight the area that you want to print, press page layout, then choose print area and say set print area. So that's going to say just print this part. And then because we want it to fit on one page, I'm going to say page setup right here. And I'm going to choose fit to 1 page wide by 1 page tall. And then I can print preview and see that that did in fact all print on one page. So I've done that for each of these. So if you wanted to print it, you should be able to do that, but that's how you would do that. I would encourage you all to always have every single workbook that you ever create print ready in case a manager or a partner or somebody that's reviewing your work wants to print it. Otherwise, in Excel, it can come up on lots and lots of different pages and be very messy and not easy to read. So always get everything print ready. Okay, so we have CRT Corporation, and the first thing that we're going to do is we're going to get this Excel workbook into tax return preparation format. So we're just going to take some of the numbers and adjust them for taxes, and I'm going to walk you through that. I want you to either do it with me by pausing and changing your spreadsheet to match mine, or watch everything, learn from it, and then do it on your own. Whichever way you'd rather is fine. So when you get finished, your spreadsheet will match mine, and that will be part of your submission. After that, we'll take it into ProConnect, and I'll walk you through that process as well. So the purpose of this is to teach you how to do a C Corporation tax return, as well as how to make sure that all your information is in Excel first, so that you know what you want to get on your tax return, so that you have something to compare it to check yourself. Okay, so we have CRT Corporation, and we have some information about it. We see that Connie and Toby each own 1/2 of the outstanding common stock, and that they are the officers of the company. They use the accrual method of accounting, and they report on a calendar basis. So our tax return will be for the year ending 12/31, that's the calendar basis, of 2020. They also tell us that they did distribute a cash dividend of $35,000, so we'll see how to report that on the tax return. I click to the next tab, and I can see the income statement. This income statement was actually given to us in a debit credit format, which means that it's not an income statement. It's called an income statement in the textbook that I got this problem from, but it is a trial balance format. So just as a reminder, income statements and financial statements don't have debits and credits on it. Why? Because users of our financial statements don't know debits and credits. Accountants know debits and credits. So this is actually, I would call this and you don't have to change this, but a trial balance. And it's actually just a portion of one because we don't have everything. That's why we're not in balance. So we were given all the debits and all the credits as related to the income statement. So we're going to take a look at that and figure out what our net income is from this. All right, so let's just look. We know that sales has a credit balance and expenses have debit balances. So that means that all of the things that were a positive for our income statement would be credits, and all of the things that were a negative would be debits. So if I just add up my debits and then add up my credits, which I did here, and I get the difference, then I can see what might be my net income. I'm saying might because there's one little issue that we have to deal with, very easy, and that is purchases is not my cost of goods sold. So in most tax returns, you have to actually complete a cost of goods sold schedule in order to calculate your cost of goods sold. So the way that we figure out our cost of goods sold is we take our beginning inventory plus our purchases minus our ending inventory, and that gets us to cost of goods sold. So what we're going to do is find beginning inventory. So inventory is something that we own that will benefit us. So that's an asset, and assets are on our balance sheet. So let's go and look at our assets. Our inventory beginning is $200,000. And again, I know that because this is January 1 of 20. And then my inventory ending is $256,000 because it's under the column that says December 31st. So this is my beginning inventory. and this is my ending inventory. So I just want to put that in. However, the less I type, the less likely I have errors. So rather than typing that in, I'm going to make it a formula. So for beginning inventory, I'm going to say equals. I'm going to click on the balance sheet, and I'm going to pick the beginning inventory. I just click on it, and then I press the enter key on my keyboard, and that puts that number in. If I were to ever change it, it would keep it updated. I'm going to do the same thing for purchases. Purchases is shown here in the income statement, and so I want it to be that number. So I'm going to click on purchases, type in the equal sign from my keyboard, click on the number I want it to be, press enter, and it puts it in there. Ending inventory is my asset. Assets are on the balance sheet, so I click on balance sheet, and then I'm going to click on ending inventory, and I can see that it's telling me that it's about to reference this balance sheet, which is the sheet I'm on, cell C4, and this is C, and this is 4, so that's the cell that I want. So I'm going to press enter, and it put it in there for me. So to calculate cost of goods sold, it's always beginning inventory plus purchases minus ending inventory tells you what your cost of goods sold is. So I'm going to press equals. I'm going to click on beginning inventory. I'm going to press the plus on my keyboard, click purchases. Then I'm going to click the minus sign on my keyboard, and then I'm going to click ending inventory. And then I'm finished with that formula, which just says C27 plus C28 minus C29. That's what I want. So now I'm going to press enter. All right, so that tells me that my cost of goods sold is $450,000. Now, cost of goods sold is an expense. Okay, it's usually the company's largest expense because it is the cost of the goods that that company sold. In this case, we're selling shoes, and so it is the cost of the shoes that we sold. So on our income statement, rather than having just purchases, we actually want this to be cost of goods sold. So because on my tax return, I'm going to be showing this as cost of goods sold, and I don't want it to be $506,000. I actually want it to be $450,000. So if I just change this right now to be $450,000, I would mess all my formulas up because I referenced that 506 and I need it to stay there. So I'm going to show you a trick. I need that number. So I'm going to say cut. I'm going to stick it over here as a little reminder and paste. Now what that did is it told this cell, hey, I need this to be now H7 because it's been moved. And it's going to remember that it is now H7. So now I can put in my cost of goods sold as $450,000. And I'm just going to type that number in because otherwise I will probably get a circular reference because I calculated that number. And so that's not true. I bet I can do it. Let me just see. Because I didn't use that in my calculation. Yeah, it'll be fine. Okay, so I just reference it and it is coming from right there. Okay, so now if I look here, my total debits now equal 884 because now I have my cost of goods sold in there, and my total credits equal 1,115,000. Now I have a net income of 231,000. That is my actual book net income. Don't worry too much about that. The book actually gave you a figure that you knew you needed to get to as the book net income. So now I know that is my book net income. Why am I saying book net income? Because that's different than my taxable income. And that's the number that we're working to get towards. But first we need to know what our book income is. And next we're going to work to get to our taxable income. So for tax return purposes, we know that all income is includable unless it is specifically excluded. So let's look at our income items. We know that credits in an income statement are revenues. So we're going to be looking at our income items. Gross sales, well, it appears that all of that would be income for our tax return. Investments in less than 20% owned U.S. corporations, that's just some dividend income to us. We own other corporation stock. That is going to be included. Then let's look at our interest income. So we know that certain types of interest income are excludable for federal purposes, and those are our municipal interest. So state and local interest can be excluded as income. So that means that this $4,000 does not have to be income on our federal tax return. So this is going to be one of our M1s. I'm calling it an M1 because that means it is an item that is on the books. This is my books, but not on the tax return. So I'm going to highlight that because that's going to be one of my book tax differences, otherwise known as an M1 adjustment. All right, let's keep going. We also will learn that premiums on life insurance for officers are not deductible. So here we deducted $8,000. We can see that it was an expense. And for tax return purposes, we will not deduct it. So that is also an M1 adjustment, or otherwise known as a book tax difference. So we're not going to deduct that for taxes. And then any interest that we paid on tax exempt income is not deductible. So loan to purchase state bonds. We took out a loan and we paid interest on these state bonds. Well, because we didn't include this in income, we can't deduct this as an expense. So this is also an M1 difference. Okay, so these are going to be items that we need to reconcile. So what I'm going to do is change this sheet just a little bit so that I can have two columns, or two groups of columns, I should say. I'm going to add a line, so I'm going to click on line 4. I'm going to right click and I'm going to click insert, and that's going to insert a row above that. And then I'm going to type right here that this is book. All right, and all of this is book. So I'm going to click on C, and I'm going to hold my left mouse and I'm going to scroll across to highlight C, D, and E, and I'm going to click merge and center. And that's going to say all of this is book. All right, I like to make it bold so that we can really see it. And then over here, I'm going to come and I'm going to say this is tax. And I'll probably use all three columns. So I'm going to highlight F, G, H, merge and center, and bold. All right, now this 506,000 is in my way, so I'm going to move it a little bit further over. So I'm going to say cut. I'm going to get it out of my way. Remember, it's needed for this formula down here. And I should probably say what it is. That's just purchases. Okay, so now this is still my debit column. Debits are always on the left. This is still my credit column. Credits are always on the right. And this is just when I need to subtotal. That's what this first column is. That's what this first column is. All right, so gross sales didn't change for tax. So we're going to just keep that same number. Sales returns and allowances did not change. So we're going to keep that number. And cost of goods sold did not change. We're going to keep that number. Investments for stocks owned did not change. We're going to keep that number. All right, state bond interest. We do not have to include that. So it's going to be nothing right here. So in this column, what we can do is say that this is our M1 adjustment. So here, I'm going to take out $4,000 so that my income now is the original $4,000 less, I put in a plus because I put that in as a minus, $4,000, and that becomes $0. CDs are taxable, so that one stays as a credit of $6,000. So now what we have, instead of the original $8,000, no, I'm sorry, instead of the original $10,000, 4 plus 6 was 10, we only have to show 6 because 4,000 of it is an adjustment. It's not taxable. So now my CD is just $6,000 and I have no state bonds. Okay, premium on life insurance, same thing. We don't have to, we have to not deduct that. So this is another M1 item. And so we're going to add back $8,000. And so here we do not get a debit, which is an expense, for tax purposes. So it is going to be that $8,000 minus $8,000. We get no deduction for tax. So here for book, we got a deduction of $8,000. For tax, we don't because we had an M1 adjustment for that. All right, we get to deduct our officer salaries, no problem. So that's a debit of that. We get to deduct our sales and clerical. So that is no problem either. State, local, and payroll taxes are all deductible, so we can keep that debit. Repairs are all deductible, we can keep that. All right, loans to purchase state bonds. We don't get to deduct that, so we're going to take that away. And then we will not have a debit for that part. So that becomes 0. And then other business loans, we do get to deduct the 10,000. So we'll keep the 10,000 right there. So the whole deduction for interest used to be 12,000 and now it is 10,000 because we can't deduct that 2,000. All right, advertising, we can deduct the entire amount. Rental expense, we can deduct the entire amount. Depreciation, in this case, we don't have a book tax difference, so we can deduct the entire amount. And other deductions, same thing. So let's add up our debits and credits and see what we're left with. So I'm going to click auto sum, and it only went that far, so I want it to do everything. So I'm going to pick up everything. And then I'm going to copy that formula to the credit, double check that it got everything by double clicking on it, and it did. And now I want to see what the difference is. So credits are income, debits are expenses, so therefore my net income right now is $237,000. So we're getting very close to knowing what our taxable income is. This is our taxable income right now. And then in our textbook, we're going to learn that there is an extra deduction. It's called a special deduction for investments where we receive dividends and it's going to be related to how much ownership we have. And this one, we have less than 20% owned in this investment right here. We're actually going to get a deduction. We don't have to include all 60,000 of that dividend in our income. We get a 50% deduction. So this is something that is done at the very bottom of page 1 on the tax return. So you'll see that when we put it into ProConnect. But right now, is that we need to adjust our tax by $30,000 because we only have to pay half because of this 20% owned dividend. So I changed this M1 adjustment to say also special. So special adjustment, so that it's not just M1s, but it's also special adjustment since we now have a special adjustment. It didn't all fit in that cell without being too wide, so I pressed wrap text, and that made it be on 2 lines so that it wouldn't be just a really long cell. Okay, so I'm going to put in 50%, so 60,000 times 50%, right there. And that's 30,000, and that's going to be a favorable adjustment. So now the 60,000, I don't have to include revenue of 60,000. I can just include revenue of 60,000 minus the 50% deduction, so 30,000. So that's going to lower my taxable income by $30,000. And that got my taxable income now down to $207,000. So at this point, I can actually see how much tax I'm going to have to pay. The current tax rate from the Tax Cuts Jobs Act of 2017 changed the corporation's tax rate to a flat 21%. So all I have to say, I typed in 21, but it showed 0 because I can either add decimals to be able to see it, or I can just click on percent to be able to see it. And so my total tax that I'm going to owe for 2020 is going to be $207,000 times 21%. So $43,470. So that's what I'm going to expect for ProConnect to calculate when I put this all into my tax return. All right, so do I owe anything? Well, in order to find out if I owe anything this year, I need to look at my estimated tax payments. And if I look through my problem, it tells me that I did make estimated tax payments of $46,000. So throughout the year, I paid in, I'm going to go ahead and wrap that too, $46,000. So when I put this in to ProConnect, I'm going to expect to see a refund, because I paid in more, of $25.30. That's the refund that I will expect. So it's a good idea to put this on Excel and see what you're going to be expecting before you put it into the tax return. So other information on this spreadsheet that we will be using, but you don't have to do anything to, is the balance sheet. So the balance sheet is going to be put into your tax return because it has to be reported to the IRS, but it's always given to the IRS on the book format. So the book numbers are what we report to the IRS. Now the only thing that we need to add, and we'll go ahead and do that right now, is a retained earnings schedule. So Schedule M2 is where we're going to report retained earnings to the IRS. So let's go ahead and show what it's going to look like right here. So it looks like a retained earnings roll forward. And what a roll forward means is that we start with our beginning retained earnings. And you can go ahead and do this with me. The beginning retained earnings, and we can find that on our balance sheet. So it's this number right here. So I'm going to click equals, pick that number up. All right, what affects retained earnings during the year? Well, first of all, net income does. So it's important to realize that we need book net income. So let's look at this $231,000. That is our book net income. But for books, we do deduct tax expense. We can't deduct tax expense for taxes because it's not a deduction for taxes, but we do deduct it out of our net income for books. So let's take that $231,000 and subtract out our tax that we just calculated of $43,470, and that will give us our book income that we'll use for our Schedule M2, which is our retained earnings. So $187,530, and I'm going to double check my number right there, make sure that I'm right. $187,530 is our right number. So this is book income that we will use for our Schedule M2. So I'm going to go back to this, and for net income, I'm going to pick up that number. So click on income statement, click on that number, and that is my net income. All right, I don't have any commas there, so I'm going to highlight that and add commas and get rid of my decimals. All right, the other thing that happens to retained earnings is that we also take out what we distributed as dividends. So it'll be less dividends. And these are dividends that we pay to our stockholders. So in the given information, I will tell you that we do have dividends, and they were paid to our two shareholders, and the amount of our cash dividend is $35,000. So this means that my ending retained earnings is going to be $636,450 plus net income minus, I'm going to put in a plus since I put this in as a negative, $35,000. And I get $788,980. All right, I can check myself because it should match my ending retained earnings per books, and it does. And so this is just an extra schedule that we have to provide to the IRS on our tax return. So I go ahead and put it here so that we'll know what we need to put into ProConnect. Okay, let's do a recap. We took a spreadsheet and then we just made some edits to get it tax return ready. So what did we do? Well, first we took the book income and we made some M1 adjustments to get to our tax basis. And that got us to our taxable income. The adjustments that we made were that we do not include state bond income. So we had a favorable adjustment here where we did not have to include the interest on state bonds as income. Then we had a unfavorable difference where we disallowed an expense that was related to premiums on life insurance. So this was unfavorable right here where we took away an expense that we don't get to expense for tax. Then this was also unfavorable where we disallowed some interest because it was used to buy tax exempt bonds. So we disallowed that. And then finally we had that dividends received deduction where we got to deduct 50% of our dividends received from a 20% owned corporation. So that's why instead of reporting $60,000 worth of dividends, we only had to report for tax return purposes $30,000. So we got down to our book income. Then we calculated what we expect to pay in tax. We compared that to our estimated payments to see what we thought our refund would be. Then we worked on our balance sheet just a bit. We said we're going to report book balance sheet to the IRS, but we need to include on a Schedule M2 the roll forward of retained earnings. So we went ahead and said beginning retained earnings plus book net income minus dividends to make sure that we were equaling out to our ending retained earnings. So that got our spreadsheet ready to input into ProConnect. So go ahead and make those changes in your spreadsheet and then save it, and that will be part of your submission. Let me know if you have any questions. Thanks.